In the following presentation, the Australian dollar will be analysed against both the American dollar and Japanese yen, compared in a number of economic indicators. Following this analysis, a prediction of future exchange rates over the next 3 to 6 months will be produced. Firstly, interest rates refer to the annual rate of interest or the return on invested savings. According to the RBA, current Australian interest rates rest at 1.5%, above current US interest rates of 1.25%. Based on economic forecasts, we expect the US interest rate to rise relative to Australian interest rates, which are anticipated to remain relatively constant in the short term. This will cause the Australian dollar to depreciate against the American dollar. This is mostly due to lower interest rates tending to be more unattractive for foreign investors, thus decreasing the relative value of a country's currency. Inflation refers to a general rise in average prices. Presently, inflation rates in both Australia and the US is resting at 1.9%. Although at the same current rate, Australia has suffered a drop since last quarter, mostly accountable to a slowdown in house pricing, whilst the USA is slowly rising from a much lower standpoint earlier this year, as according to the CNBC, following Hurricane Harvey, which amongst causing massive destruction amongst the Gulf Coast and other areas, also forced the shutdown of multiple refineries, which caused their inflation rates to drop. Despite this, Australian inflation rates are forecasted to be relatively higher than American inflation rates in the future. Based on this forecast, a higher relative inflation rate will reduce the value of the Australian dollar against the American dollar. This is due to higher inflation rates reducing the demand for Australian exports, thus causing the demand for the Australian dollar to also fall relative to the American dollar. Economic growth refers to the amount of goods and or services produced in a population over a period of time per capita. Currently, Australian GDP growth rates are at 1.8%, whilst US growth rates are at 2.2%. Australian growth is higher than the last quarter, mainly due to a solid export increase, mostly iron ore, according to the ABC News. Whereas USA growth rates have been much higher than ours due to an increased amount in consumer spending and investment, increasing both private consumption and private investment expenditures. This causes the Australian dollar to yet again depreciate against that of the US dollar. Lower relative growth rates will cause a depreciation due to its downwards effect on interest rates. Based on this information, it is expected that the Australian dollar will trend downwards against the American dollar within the next 3 to 6 months. A combination of factors listed include interest, inflation, and GDP growth rates, which all point at the depreciation of the Australian dollar relative to that of the American dollar.
Hi, my analysis today will focus on the Australian dollar and the Japanese yen, with a comparison and analysis of these two currencies using the macroeconomic factors of interest rates, inflation rates, growth rates, and exchange rate expectations. Current interest rates in Australia stand at 1.5%, with Japanese interest rates at negative 0.1%. After dropping nearly an entire percent after Shinzo Abe was elected Prime Minister of Japan in 2012, Japanese interest rates are now hopeful of remaining relatively constant in the short-term future. However, Australian interest rates are forecasted to increase in the short term, indicating that the Australian dollar will appreciate against the Japanese yen. The currency will appreciate because higher relative interest rates will attract greater foreign investment, which in turn increases the currency's relative value. According to current Reserve Bank of Australia figures, the Australian inflation rate has gradually decreased over the past 4 to 5 years, currently standing at 1.9%, with Japanese inflation rates remaining relatively constant at 0.4%. In the short-term future, the Japanese inflation rate is expected to rise at a rate that is marginally higher than Australian inflation rates, according to Focus Economics, who believe that Japanese inflation rates are likely to rise between 0.6% and 1.6% over the next fiscal year. This indicates that the average prices of goods and services are expected to rise at a greater rate in Japan compared with Australia, meaning that the Australian dollar will appreciate against the Japanese yen. Lower relative inflation rates directly correlate with a higher demand for exports and demand for the Australian dollar, which increases the AUD's relative value. GDP annual growth stands at 1.8% for Australia and 1.4% for Japan. With regards to recent figures, both countries have had relatively constant GDP figures over the last 6 months, with Japan perhaps decreasing at a very slow rate. In future months, both countries are expected to have lower rates of growth, with Australia decreasing at a slower rate, indicating they have higher relative growth rates. Higher comparative GDP growth rates indicate that the AUD will once again appreciate against the Japanese yen. Growth rates have a direct impact on interest rates, meaning a higher relative growth rate will increase relative interest rates, which in turn attracts more foreign investment and increases the relative value of the currency. Based on the previous evidence provided, it is expected that the Australian dollar will appreciate against the Japanese yen within the next short-term period of 3 to 6 months. Relative interest, inflation, and growth rates all indicate this to be the case. As demonstrated by the illustration, comparing these two currencies over the last month supports our hypothesis that the value of the AUD will continue to rise relative to the Japanese yen. After this analysis, we have come to the conclusion that in the next 3 to 6 months, the value of the Australian dollar will fall relative to the US dollar and rise relative to the Japanese yen. Comparing both currency pairs with the macroeconomic factors of interest rates, inflation rates, and growth rates have given us a more developed understanding of the impact of these factors on the exchange rate market and the value of currency. Thank you for listening to our presentation.